In this video, we will learn how to measure financial ratios for investment purpose using the financial statements like income statement, balance sheet, and cash flow statements. So these are the financial statements: income statement, balance sheet, statement of cash flow. We just required both of these statements, income statement and balance sheet. We can measure how to calculate ratios using these two statements for investment purpose. So what's the financial ratios? The financial ratios analysis is an essential tool for evaluating a company's performance, stability, and investment potentials. Earning per share and price to earning reflect profitability and market expectations, while the price to book ratio helps assess stock valuation against the company's book value. Dividend yield attracts income-focused investors by showing the return on investment through dividends. Return on equity measures how effectively a company uses shareholders' funds to generate profits. To assess financial health, the debt to equity ratio highlights leverage and risk, and the current ratio ensures the company's short-term liquidity. Finally, gross profit margin reveals how efficiently a business manages production costs. Together, these eight ratios provide a comprehensive snapshot for making smart, confident investment decisions. For depth understanding that how to calculate these ratios, let's move. Earning per share. This refers to how much profit a company generates for each outstanding share. It helps investors understanding the company's profitability on a per share basis. The formula is net income minus preferred dividends average outstanding shares, where we put net income to in this formula. So we can take net income from P&L, dividend from equity, average outstanding shares from balance sheet. For example, a company earns a net income 1 million and has 2 lakh shares outstanding. 1 million divided by 2 lakh is equals to 5 per share EPS. And the other, how we calculate price to earning ratio, indicate investor expectations by showing how much they are willing to pay for $1 of company earning. Then how we calculate this ratio? Market price we can take from the stock exchange, and the earning per share we can take from the P&L. For example, if the stock price is 50 and earning per share is $5, so when we calculate these, we can find the this means the stock is trading at 10 times its earning. Price to book value ratio compares a stock market price to the value of its underlying assets. It helps assess whether a stock is undervalued or overvalued. Now, how we calculate this? Price to book ratio, market price we taken from the stock exchange, book value per share we can taken from the balance sheet. If a company's stock is priced at 40 and the book value per share is 20, So price to book value 40 to divided by 20 is equals to 2. Investors are paying twice the book value. Dividend yield. Dividend yield tells investor how much cash return in the form of dividends they receive for each dollar invested in the stock. Now, how we calculate this? Annual dividend per share we can take in from the P&L and the market price per share we can take this from stock exchange multiply by 100. For example, if a stock pays $2 in annual dividend and trades at $40, dividend yield, and we calculate this. And now we can find the value of dividend yield 5%. Return on equity indicates how effectively a company uses shareholders' equity to generate profit. It shows how well management is utilizing investor funds. Now, how we calculate this? Net income divided by shareholders' equity. Shareholders' equity multiply by 100. Then we find the return on equity. Net income, for example, net income is equals to $5 lakh, shareholders equity $2 million. 5 lakh divided by 2 million multiplied by 100. 100 for just we take when we take the 100 indicates that we finding the percent debt to equity ratio shows how much debt a company uses to finance its assets relative to equity. High leverage can mean more risk but also potential for higher returns. Now, how we calculate this? Total liabilities. Total liabilities, we can take this from the balance sheet. Shareholder equities, also we can take this from the balance sheet. For example, total liabilities $1 million, equity 5 lakh. So now we calculate 1 million divided by 5 lakh is equals to 2. The company has $2 of debt for every $1 of equity. Current ratio assess a company ability to pay its short-term debt using its short-term assets. It reflects financial health and stability in the near term. So how we calculate this? Current ratio is equals to current assets divided by current liabilities. We can take these from in the balance sheet section. These all are the current assets, current liabilities. These all are the current liabilities. Current assets divided by current liabilities. Now this means the companies has 2x the assets needed to pay its short-term debts. Now the final gross profit margin indicates how well a company controls its production cost compared to revenue. A higher ratio means better efficiency in generating profit from sales. Now, how we calculate this? Gross profit margin, revenue minus cost of goods sold divided by revenue. Revenue we can take in from the P&L. Also, cost of goods sold we can take in from the P&L. These are the items related to cost of goods sold. Now, for example, revenue, we sell something $5 lakh. The cost of goods sold $3 lakh. Now how we calculate this revenue minus cost of goods sold divided by revenue multiply by 100, we can find the average of the gross profit margin. Thank you for watching the video.